The perfect enemy of a good plan is the dream for a perfect plan.
The perfect enemy of a good plan is the dream for a perfect plan. Who said this was? A Persian war theorist. And he was talking about the need for perfect plans. You do not need a perfect plan. All you need is a plan. Work through it as you make things work. Anyway, this is why we're going to be talking about my multi-million-dollar dream. And I do not need a perfect plan. I just need a good plan. And I'm going to give you a good plan and you want to enjoy it. Welcome guys, welcome to Kenneth's Money Matters. So today we're going to be talking about my multi-million-dollar plan using a very simple 3-asset portfolio, which I'm going to give you. And the reason I'm doing this is not to brag or to show how big my dream is. The reason I'm doing this is to make sure that you can also come with me on this plan and let's make money, guys. It's simple, an investment process that will make you rich in very simple ways without you struggling, without doing so much work, without always worrying about what's happening with your stocks that you picked and stuff like that. So this is the perfect plan. But even though we don't have to wait for a perfect plan. So guys, I hope you are excited to invest. I hope you are excited to make money. Like I always say, there are so many opportunities in this life. You do not need to struggle so much to find them. You just need to be smart to find them. So I am coming up with this 3-asset portfolio, and it is the perfect portfolio for someone who is working. Basically, this is a really good plan. It's a very simple plan. I have done a good research on this. I've done research on some of the best investors. You know, I do a lot of research on Warren Buffett, which I've actually done a video on. But on this particular video, I've done a research on David Swansea, which is my best investor ever. I've done research on Bogle, who is one of the best people, the founder of Vanguard, index funds mogul, the one who has actually made me start investing in index funds. And then I've done some research of a lady by the name of Gretchen Tai. So these are 3 different people. They're investment moguls. People have actually succeeded quite well in their areas of investment. If we start with David Swansea, I don't know how to pronounce that. David Swansea. If we start with David Swansea is the Yale portfolio manager, Yale University portfolio manager, and he has managed to achieve a constant return from the stock market of 13.9, averagely 14%. Since he took over, he has added an average of 20.6 billion to that portfolio. Think about that. The guy is good. Not so many people, not so many investment managers have managed to beat the market returns over a long period of time. He is one of them. One of the very few who has managed to give a very consistent return, beating the market. But still, he has a completely different advice for those who want to succeed in investing. And it is not just picking stocks like he does. That's number 1. Number 2, Gretchen Tai. Gretchen Tai is a manager of pensions and 401k plans in the US. She's also done a very good job with regards to investing. She's done a very good job with regards to advising people on what actually to invest in. And her track record is amazing. Gretchen Tai is one of the moguls or the gurus of investing. And last but not least, like I said, my favorite person is Jack Bogle. I've read his book on investing, a very good book on smart investing. And he's the founder of index funds and the founder of Vanguard Group, one of the best investment funds you can find out there. So guys, these 3 people will give us that path we're going to follow. So I'm not going to copy exactly what they do say or what they propose, but I have done research on each and every one of them, and I've picked some of the common areas. And those common areas come as a way of 3 stock portfolio for me and 3 rules. So 3 assets portfolio and 3 rules. So after doing research on David Swansea, on Tai, and on Bogle, I've come up with 3 asset portfolio and 3 rules. If you follow these rules, you are definitely going to be a multi-millionaire. And I mean this in dollars. I know so many people are watching from Kenya. So I can assure you that if you follow these rules and invest the right amount of money, you don't have to worry about being a dollar millionaire. We're going to give the rules that I'm talking about, the 3 simple rules, and then we look at the stocks that match the criteria for these rules. So first of all, let's look at some of the rules that all the 3 people that I've spoken about agree on. And these simple steps will make you a millionaire. Number 1, diversification. If you're going to have a very efficient portfolio, you must diversify. And diversification in this case means you must own, whether it is stocks or bonds or real estate, it has to be owned from different parts of the world. It can come from different baskets, can come from different parts of the world. Basically, it shouldn't be in one basket. You shouldn't just own stocks in the US, for example, or own stocks in emerging markets, for example, or own US treasuries, for example, at 100%. So the main thing they all agree on is that you have to diversify your portfolio. And how do you diversify that portfolio? By having a three asset portfolio, you already are diversified enough, but within that portfolio you still can manage diversify quite well. So they all agree that you must diversify. Someone, for example, David Swanze says you can have stocks, but in these stocks you must have domestic stocks, and this he was speaking in the US. You must have domestic stocks, you must have international stocks, international developed world stocks, and then you must have emerging market stocks. And then when it comes to bonds, again, you can diversify between US treasuries and international bonds. So that diversification gives you a leverage, gives you a good foundation in terms of investing. So all of them agree on the fact that your portfolio should have varied assets. You can have stocks, you should have bonds, and you should have real estate. So Jack Bogle doesn't speak about REITs, which is real estate investment trusts, which is just basically owning stocks that invest in real estate ownership. But he doesn't talk about that. It only talks about index fund investing. Even though the two above, Ty and David Swanze, talks about owning real estate, which is REITs in that portfolio. So you don't have to buy real estate in real sense. You just have to invest in stocks that invest in real estate. I don't know if it makes sense. Diversification is important. You must own more than just one thing in that portfolio. And they all agree with that fact, even though they go about it in slightly different ways. For example, Ty goes about it in a very diverse way. She goes into different kinds of bonds and the high yielding, low yield dividends. She also goes into different kinds of stocks, emerging markets, small cap, large cap US, small cap US, developed world. So she goes deeper into the diversification, even though the other two don't go so deep into diversification, but still those portfolios are quite well diversified. And that's why I said I came up with my own way of doing this and making sure that you achieve your dreams. Number two is low fee funds. You have to ensure that the management fees is quite low. This is a big thing because a lot of people pay so much fee for investment advisors, or they pay so much fee for those who pick stocks for them. But these fees, when you accumulate them, you end up losing a lot of money, and sometimes you do not make that return from the market. If you pay so much in fees, you end up losing money, or you end up making much less, and those fees do accrue and become so much at the end of it, because you're looking at long-term investment. So low management fees is very important. Every fund you're going to invest in, every portfolio you're going to invest in, you have to ensure that it gives you very low management fees, and I will mention some of them at the end, towards the end of the video, that gives such low fees. So the second thing that we must take into consideration, and that all these investment gurus agree on, is that you have to manage your fees. You have to be careful and keen on the fees that you charge. So that's another very important point. Make sure that you're getting very low fees on your investment and management of your portfolio. And they all agree on that fact. And the third one is simple. You need to rebalance your portfolio once in a while. This is basically to make sure that you still own the stocks and the bonds and the rates in balanced way, so that not so much has gone towards the stocks and not so much has gone towards the bonds. Because when the money gets back and is reinvested, sometimes the stocks and the bonds become a bit imbalanced. So you have to balance it all the time to make sure it reflects what you want. So if you want 70% stocks and 20% bonds and maybe 10% rates, you have to ensure that that balance is always there. And then you also have to balance based on your age. You don't want to be risking too much at old age or risking too little at a young age. So when you're 20, 30s, you want to risk more. By risking more, it means you put more money in the stocks market, which will give you better returns. And in your 60s and 70s, you want to have more money in bonds, which is more secure but with less returns, and have less money on stocks, which are very volatile. So you have to do that balancing with age, you have to do that balancing with time, you have to make sure that it reflects what you actually want to achieve. So all of them agree on this balancing act. Jack Bogle, of course, always says you should own your age in bonds. If you're 30 years old, that should be your bond percentage in your portfolio. If you're 20 years old, that should be the bond percentage you own, and then the rest should be stocks. So they do vary a little bit in terms of what they say, but at the end of the day, it's the same idea. They say rebalance your portfolio with time, rebalance your portfolio to meet your goals, and make sure that you're not risking too much when you are too old because you do not have enough time to recover. And you're not risking too little when you're too young because you still have a lot of time to recover. So rebalancing is extremely important. So these are the three simple rules that you need. You need to diversify your portfolio. You need to make sure that your management fees are low. And number three, you need to rebalance it all the time with age. Make sure it reflects what you want to achieve. And now we go and look at what are some of the stocks that you should own in this 3-asset portfolio. And this is the crunch of this video. So what are these stocks that meet these 3 criteria and that these 3 gurus agree on? So David Swensen and Gresham Tai agree on owning some REITs. REITs, I said, is Real Estate Investment Trust. They agree on owning some REITs in your portfolio. So they talk about stocks, and within the stocks there's also vary, and then they talk about bonds, and they talk about REITs, which is Real Estate Investment Trusts. So basically they talk about those 3, but those 3 are also diversified into smaller units. I won't go into that, but basically these 2 agree on the fact that you should own REITs. But the boggleheads, and when I say boggleheads, it means those who follow Jack Bogle to the T, the funds, believe that you should just have index funds. So basically, if you're tracking, for example, the S&P 500, if you're tracking the Dow, for example, that is where you should stick. And you should only own bonds and stocks. So the boggleheads will not agree with this. That's why I came with my own, based on my research of the 3 people, my own research and my own preference in this case. And looking at all the 3 people and their variances, I think I would go with having stocks in my portfolio. So I will say that 70% of my portfolio will be stocks, and that stocks will be following the S&P 500. It will be index fund. Basically, I'll be tracking the S&P 500. And then the second part of my portfolio will have the total international index fund. So basically, this will be looking at the other countries besides the US. So if I'm tracking the US, it means I'm domestic with regards to the US. I will be tracking the other part, which is the international index fund. And Vanguard has one of these whereby you can just track the major index funds internationally. That will be Europe and emerging markets combined. So that will be the second part of my portfolio. And the third part of my portfolio for now will be real estate investment trusts. And this is basically owning shares in those companies that actually own property for renting or for letting. So looking at my 3-asset portfolio, I have local, which is domestic US. I'm tracking the S&P 500. Then I have international, so I have exposure to Europe. I have exposure to emerging world markets. And then I have REITs, so I have exposure to real estate investments. Now, this is based on my own research, based on my own investment goals, and it does not mean that you have to follow the same path. As you realize, I don't own any bonds for now, and that is because, one, I own bonds in a different country, in a different procedure altogether, in a different investment. So I don't need to own bonds again. And number 2, I'm still young, so I have a lot of time. I do not want to waste my time getting very little returns from the bond market, where I can get that money from the stock market, from the real estate, and from international stocks. So there is my portfolio, and I believe that it's going to get me very far. It's going to give me multi-million dollar results, hopefully. And of course, I have to follow the 3 rules, like I said earlier, and I have to be consistent with my investing, and I have to make sure that I put in money that will actually give me those results. I don't just have the portfolio without putting in money, so you have to constantly invest. That's the only way you can achieve that dream. So which are some of the investment companies that actually offer these options? So for those in the US, for those in the UK, for example, you have Vanguard offering the Total International Index Fund, the Total Market Index Fund, Emerging Markets Index Fund. We have the Fidelity, for example, which again offers tracking of the S&P 500 Total Market Index Fund. It also has international fund. It also has real estate investment trust fund. Again, those in the US, in the UK, we have Vanguard, we have Fidelity, we have Schwab with very low fees, some going as low as 0.01%, which is extremely low. So just make sure you do your research. Like I think I did another video which is focused on these fund providers. So basically, wherever you are, whether you're in Kenya, the UK, the US, just make sure you find the right vehicle for it. I can do another video focused on, a identifying which vehicles are right for this kind of investments. So, but for those in the UK, for those in the US, it's very simple. Fidelity, Vanguard, Schwab, some of the best. And of course, there are many others, so many others. Yeah. So whatever sits well with you. And of course, like I said, you have to just make sure of the three things. Take care of the fees, management, take care of the diversity, and make sure you rebalance. So it's a very simple process. You just need to put your head into it and get going. So we're going to achieve this dream, guys. I hope you are with me. Let's get going and let's meet at the end of the line when we are super rich. Comment, let me know what you think below.